Hey everyone, this is Ryan Chen, your loan cater, and if you only watch one video about debt, make it this. You can shop rates, compare offers, read every term sheet, and still end up paying 10 times what the business next door pays on the exact same dollar they borrowed. I've funded over 1,000 business loans, and I started at one of the largest MC brokerage in the country before building Loan Cater. And what I learned is that business debt doesn't punish bad businesses. It punishes the one who doesn't know what the person across the desk is actually optimizing for. So I put everything in one video. Today, I'm laying out 6 things about business debt that nobody in this industry has any incentive to teach you. So by the end of this, you know exactly what's happening on the other side of the desk, what your capital should actually cost, and which options they're keeping off the table. Now, the first thing is that interest rate on a term sheet is designed to distract you. Lenders lead with rates for a reason. It's the number one thing every business owner compares, and while you're going back and forth between 8 and 12 and 15%, the things that actually determine what you pay every month barely comes up. $200,000 through an SBA loan at 10.8% over 10 years costs you roughly $2,700 a month. $200,000 through a merchant cash advance at a 1.30 factor rate, payback over 8 months, costs you roughly $32,500 a month. That's the same amount of capital at 12 times the monthly debt service. And the SBA loan has the higher number on the cost of capital over the 10 years. Your actual out-of-pocket monthly expense is a fraction of the MCA because the term is 12 times longer and the payments hits monthly instead of daily. That's the difference between rate and monthly debt service, and most business owners never learn to separate the two because the industry benefits when they don't. But the rate being misleading is only half of it, because the person explaining the rate to you has a financial incentive to make sure you never understand the full math. The commission structure in most of the lending industry is built so that the person sitting across from you makes more money when you pay more. In the MCA space, a broker's commission is tied to the total payback amount. So if they put you in a deal with a 1.50 factor rate instead of a 1.40, the check goes up and you're the one covering the difference. Nobody in the room is getting paid to find you the cheapest option. They're getting paid to close, and the more expensive the deal, the bigger the payout. Now, banks work differently, but the incentive is not much better. A bank earns revenue on the spread between what they borrow at and what they charge you. So they're offering you their rates on their products, and if you don't qualify, that's the end of the conversation. They're not picking up the phone calling credit union that might approve you at half the cost or walking you through the SBA program at a different institution that fits your file better. And that brings me to the third thing. Because the institution most business owners trust the most with their capital decisions is often the one least motivated to help. Your bank does not want to lend to small businesses. And I know that sounds harsh, but the numbers back it up. Banks decline the majority of small business loan applications. And for most banks, small business lending is not a profit center. The real money comes from deposits, commercial real estate, and large corporate lending. And $300,000 SBA loan for the HVAC company takes the same underwriting as a $3 million commercial deal, but generates a fraction of the revenue. So the bank's preference, whether to say or not, is to pass. And what costs business owners the most money is what happens after that note. Because the bank is never going to decline you, and they'll walk you through the SBA programs, the HELOC options, DSCR loans, the credit unions that might approve you at a different rate. They just say no. You leave, you Google fast business loans, and 24 hours later, you're at an MCA at 70% effective APR because that was the first thing that said yes. The path from bank decline to MCA is the most expensive 48 hours in small business finance. And it happens because nobody in the process had any reason to show you the full menu. Now, all these rates distraction, commission structures, bank incentive problems create one downstream effect. They shape how your file looks to every lender who touches it after. And the story that file tells right now is either opening doors to cheaper capital or slamming them shut. And whether you're on the right side of that comes down to 3 numbers most business owners have never calculated. But before I share those 3 numbers, if you want us to actually pull your numbers and show you what your file looks like from outside the desk, I'll leave a link in the description where you can fill out an application. Our team breaks down exactly what you qualify for and what your cheapest path through structuring looks like. Now, what you need to know is that every dollar of debt you carry right now is being measured by 3 numbers on your file. And those 3 numbers carry more weight with lenders than almost anything else. The first is your DSCR, which stands for debt service coverage ratio. That is your net operating income divided by your total annual debt payments. And if yours is above 1.25, Lenders see a business that can carry its obligation and still run. But if it's below 1.0, you're spending more on debt than your business generates, and no conventional lender is going to touch you. The second is your credit utilization. If revolving lines and cards are sitting above 70%, that tells the lender you're running tight, and one bad month could tip over the whole thing. And the third is your cash flow trend. How your bank statements look over the last 3 to 6 months. If you got daily ACH debits from stacked MCs eating $1,500 a day out of your operating account, that shows up on every bank statements. And every lender who opens those statements read the same story. Two businesses with identical revenue, credit scores, and time in market can walk into the same lender and get completely different outcomes. One gets approved at 8% over a 10-year term, the other gets offered a 35% deal over 12 months or decline. And the only difference is what their file looked like walking in, which is really just a reflection of how they structure the debt they already had, and that compounds in both directions. Good structure improves your ratio, which qualifies you for cheaper capital, which improves your structure further. That structure taints your ratio, which locks you out of the product that could fix it, which pushes you down even more expensive options. Most business owners have never seen their own files through a lender's eye, and that blind spot costs more than any single interest rate ever will. But even when you understand what your file reads, there's one variable that can inflate your cost of capital by 5 to 10 times overnight, and most business owners don't think about it until the bills show up. The faster you need money, the more it costs. And I'm not talking about 10 to 20% more, I'm talking about 5 to 10 times. A merchant cash advance at 70 to 150% effective APR takes about 24 hours. That urgency premium is the single biggest cost in small business lending, and the entire industry is built around it. Because the business owners who need capital by Friday doesn't have time to shop rates, compare terms, and negotiate, they take whatever says yes first, and whatever says yes first is always the most expensive option on the table. And urgency compounds. The expensive deal you took because you were in a rush creates daily debits that squeezes your cash flow, which creates the next crunch, which sends you right back to the same expensive lender. If you know you're going to need expansion capital, equipment, or refinance in the next few months, start that conversation now. Every month of lead time is money back in your operating account, which brings me to the one advantage that eliminates most problems I just described. Almost every problem I just described. And it costs nothing. The business owner who pays the least for capital are the ones who were never in a rush to get it. Right now, private equity firms are sitting on over $2 trillion, what they call dry powder. That's capital stage and ready to deploy the moment an opportunity shows up. The best operator in every industry do the same thing at their scale. They establish a line of credit. When your books are clean, your revenues is strong. They get pre-approved before they ever need to draw. And when a competitor goes under and the employees are available, or a prime location opens up, or a contract comes through that requires scaling fast, they move when everyone else is still scrambling to apply. Your negotiating power is at its peak when your file is clean, your cash flow is strong, and you don't need the money. That is the exact moment most business owners never think about borrowing. And by the time they do, the file has weakened, the cash flow is tight, and the only options left are the expensive one. Every single truth I walk you through today connects back to this. When capital is urgent, you don't have time to question the rate, the commission, or the terms. Banks are the least useful at the exact moment your files needs them the most. And the lenders who will say yes in 24 hours are always the most expensive one in the room. All of that disappears when you build your lending relationships before you need them. Now, with everything I laid out, the framework is the same for every business. But the specifics, like what position to restructure first, what products to apply for, when to pull equity versus when to leave it alone, is different for every file I look at. And getting it wrong, even something as small as refinancing the wrong order, can set you back a month and cost you thousands you didn't need to spend. That's what we sort out at LoanCater. We take your full file and map out the path that gets you the cheapest capital your business qualifies for right now, instead of the most expensive options that happens to say yes first. We've done this over 1,000 times across 50 lending partners with 60% approval rates. So if you want someone actually sitting on your side of the desk, showing you exactly what you qualify for, what it should cost, and what your first move should be, I'll leave a link in the description below that you can check out. Thank you for watching, and I'll see you in the next one.